All right, let's get right into it. It's January 25th, and we need to have a serious talk about what's going on with the DexFi fund. The headline number, well, it shows the deep correction. But as you're about to see, the data underneath is telling a completely different, and frankly, an explosive story. And you know the drill. Before we kick things off, just the standard reminder, this is all for educational purposes. This is not financial advice. Please always do your own research. So let's tackle the elephant in the room, the question that's on everybody's mind. The fund has taken a serious hit, down 24% from its peak. What is really going on here? Is it time to hit the panic button, or is there a lot more to this story? To figure that out, we have to begin with the honest, unvarnished truth. No sugarcoating, no spin. We're going to look directly at the numbers that are causing all this concern, because there is no denying they are significant. First up, the raw dollar amount. Since that all-time high on January 14th, the fund is down nearly $500,000. That's a number you really feel. That one stings. And in percentage terms, well, that translates to a 24% drop from the peak. This is officially what we call a deep correction, and it's wiped out a huge chunk of the gains from that last rally. Now, this one is a big deal from a technical standpoint. The fund is now officially dropped 3.7% below the Christmas low. That was a key support level that held strong for the last month. Breaking below that, yeah, that's a bearish signal we absolutely have to acknowledge. So here's the dashboard all laid out. The current fund value is sitting just over $1.5 million. It's down over 470 grand from the high, and now it's below that critical Christmas support level. So let's be crystal clear. On the surface, the picture looks undeniably tough. But here's the real question. Is that the whole story? Or is the market sending us other, maybe even more powerful signals just beneath all that price action? This is where things get really, really interesting. Okay, check this out. This is the first major counterpoint. Look at what this correction has done to the annual percentage rate. When the fund was hitting its all-time high, the APR was a very healthy 25.5%. Today, as a direct result of this drawdown, it has surged to almost 32%. The yield has just dramatically increased. And this right here perfectly illustrates the opportunity. Because the bond prices dropped to just over $56, your capital goes so much further. Think about it. At the peak, $10,000 would have bought you about 134 bonds. Today, that exact same 10 grand gets you 178 bonds. That is a 33% discount. You're getting a third more of the protocol for the exact same price. All right, but this next piece of data is, you could argue, the single strongest counter-narrative to the price drop. We are seeing a massive, almost unprecedented explosion in trading volume. Just look at this. Yesterday, the protocol handled nearly $18 million in trading volume. This isn't just a big day, folks. This is the second highest volume day in the protocol's entire history. This is not the sign of a project that's dying. This is the sign of incredibly intense market activity. So where did all that volume come from? Well, the AVNT token was responsible for a staggering $7.6 million of it. That's 43% of the total. When you see this kind of insane volume on a single token during a deep correction, it usually means one of two things. Either mass capitulation from sellers giving up, or massive accumulation by buyers scooping things up. Either way, it's the kind of volume that can mark a bottom. So why the big drawdown in the first place? Well, a huge piece of the puzzle is just the broader market. You know, ETH is down almost 17% from its own recent high. Our fund has shown about a 1.4 times sensitivity to ETH's moves. So a 17% drop in ETH translates to a 24% drop in the fund. And here is the most important thing to remember. This amplification works both ways. A recovery in ETH could lead to an even faster recovery for us. So how is the protocol itself reacting to this dip? It's putting the capital to work. The deployment rate has hit 95.71%. That's a record high. This means the Treasury isn't just sitting on the sidelines in fear, it's actively deploying capital into the vaults to take advantage of these lower prices. That is a strategic, confident move. Now, let's put today into some perspective. Over the last 46 days, we've basically seen this exact cycle play out. We had that initial drop into the Christmas low, which was followed by an epic 26% rally to a new all-time high, and now we're in another deep correction. Yes, we are technically down over the whole period, but the journey shows that these markets move in powerful, powerful ways. So what's the final verdict for today? We're in a deep correction. There is absolutely no way around that. The negatives are clear as day. We're down 24% from the high, and we're below a key support level. But the positives? They are screaming just as loudly. The APR has surged to nearly 32%. Bond prices are at a massive discount.
volume is near an all-time high, and capital is being deployed strategically. This is a deep correction. That's the honest truth. But underneath that scary headline, the data suggests there is so much more to this story than just the drawdown. These are not the signs of a failing protocol. These are the signs of a market trying to find its bottom. And at the end of the day, only you can decide if this is capitulation or if this is opportunity. And to close us out, our full risk disclosure. This content is for educational purposes only and should never, ever be considered financial advice. Please, never invest more than you are willing to lose, and always conduct your own thorough research before making any investment decisions.